thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are the views of Sandeep Kalra of Persistent. And they continue to deliver industry-leading growth this quarter as well, about 9.3%, if I'm not wrong. I mean, YOY would be 34%, but well, quarter on quarter is really the meaningful point. The beauty about this growth from Persistent is that it's a very high growth on a high base, because the last arguably 6 to 8 quarters have been strong for them. He had guided to this, so to say, maybe not in official terms, but spoken about it, so it doesn't come as a surprise. The question to Sandeep Kalra is more about the texture of the quarter and how does he see the second half. Sandeep, great having you, and congratulations on a good set of numbers again.
Thank you, Neeraj. Thanks for having me. So, as you rightly said, this was a strong quarter for us, both quantitatively and qualitatively. And let me give you a color on the same. So, this quarter, the revenue came in at about $182.3 million. This is 9.3% sequential in dollar terms and 9.9% sequential in rupee terms. In year-on-year basis, it's roughly 34%, 34.1% dollar and rupee terms. The order bookings as well came in very healthy. So, we announced order wins of about $282.5 million in total contract value terms. The annual contract value out of this is about $201.1 million. Overall, if you look at the margins as well, we gave sequential improvement in margins. The EBITDA came in at about 16.6% compared to 16.4%. EBIT also improved from 13.4% to 13.9%. Now, if I look at the qualitative side of it, we have been talking about the M&A strategy being tuck-in acquisitions. So we announced 2 acquisitions, one in the payment space, which is SCI, one in the cloud space / infrastructure space, which is She Partners. And finally, we are very proud to announce we were recognized by Forbes Asia as one of their best under $1 billion, the 200 companies in Asia Pacific. And this is on basis of the consistent top line, bottom line growth. So all in all, pretty strong quarter for us. And we are, continuing to see good traction. So that's where we are.
Okay, a couple of hygiene questions first, and then we move on to the other parts. So the margin performance was, I thought, the reason I thought it was commendable is because it came despite one, I believe, higher headcount, and I believe higher attrition. So 2 questions rolled into one. Is this a kind of sustainable, depending on what kind of wage hikes you have to give? And 2, does the attrition concern you? And please tell me if I'm wrong, but when I saw LTM attrition, the number was very high. Q1 was about 16%. So is it that the attrition numbers have really gone through the roof this quarter, or am I mistaken?
So 2 parts to it. So first part is the margin side of it. So we have always said we want to be in the 16 to 17% margin band, and growth is the priority for us. And we have been consistently, delivering on it. So that's as far as the margins are concerned. And we'll try to be in the same band. Some quarters may be higher, some quarters may be lower. There are many different levers, whether it's your pricing, whether it is your utilization, whether it is, as the revenue goes up, it gets defrayed over, the costs that are fixed costs, SG&A, etc., get defrayed over a higher base. So there are always puts and takes. So 16 to 17% band, sticking on to it. Now, as far as the attrition is concerned, look, it's always glass half empty or glass half full. Now, attrition happens if you look at it because there's high demand, and there's high demand across the tech sector, whether it is the product companies themselves or enterprises themselves, or companies like ourselves and our peers. So that's a good problem to have. I would take this problem any day than have a lack of demand. Now, having said this, when there is demand, the system will adjust itself to, bring in the supply. A lot of us, whether it's bigger peers of ours, mid-tier companies, us, we have talked about how we are structurally looking at bringing more freshers, bringing more talent from other industries, training them for the kind of skills that we have. And that's what we are on to. Now, unfortunately or fortunately, we are at the front end of the digital transformation side. Most of our business is on the digital side. So that makes us a little bit more, on the higher side of attrition. Does that bother us? In a healthy way, it does. And we have been working very, strategically on making sure our employee value proposition becomes even more stronger with time. So if you look at the quarter gone by, we also announced an ESOP for 80% of our company. And it was basically on behest of the request from our employees that we've done very well in our performance. Because of them, they contributed to our performance. That led to the shareholder wealth creation, and they requested us to have them participate, and that's what we have done. So this is going to be a multi-year participation for them in the wealth that they help us create, and that fortunately will also, make it much more better as an employee value proposition. So hopefully supply constraints easing up over the next few quarters with more, supply coming in, with our employee value proposition getting even more stronger. we should see a relief on this in the next few quarters. But I'm not, overtly worried. We are healthily worried, and we are at it. And look, with the same attrition, we have delivered industry-leading growth. So that's the proof of the pudding.
Yeah, I completely agree. By the way, you must be one of the rare companies which has given ESOPs to 80% of the employees.
Absolutely. I would be very surprised if we have any of our peers, competitors, whatever you may call them, have 80% of the company participation, in the wealth creation that they help us to. So I'm very proud of it. I'm very proud of our, investor approvals, board approvals, that we were able to do it.
Forget your peers. I don't think I've heard about this in other industry as well. So quite commendable. Great stuff. Good for your employees. Just one very quick follow-up before I get to the acquisition part as well. Sandeep, I saw while healthcare did really well, it was largely still broad-based, because it's not that the other verticals had, patchy growth, if you will. Almost everything did really well. Is it by design, or is it just happening and it could be lumpy going ahead?
So look, it is by design. There is, luck favors the brave. So we have put our strategies in place. We have different teams that focus on BFSI, healthcare, life sciences, tech sectors, and there are some dynamics within that. And we, go by design on making sure our the value proposition for our customers is standard. So, for example, even the acquisitions that we have talked about, payments is at the heart of the banking financial services industry. So it is by design that we are going and strengthening our value proposition. That's one. Second, if you look at structurally, what is happening? The enterprises, as they're coming out of COVID, they realized in COVID, the digitization helped them a lot. Whoever survived and thrived were the people who were, on the front end. More and more people are embarking that journey. Now, with that, what it means is the tool providers, the ISV companies, they are seeing more demand for their, products. And there's one other dynamic in the background. There's a lot of private equity and VC money that is sitting on the sidelines. So there's a lot of committed money when you look at private equity, which is basically the dry powder, as they call it. And that will structurally get deployed over the next few years. So it's not just now. So we are looking at that getting deployed into product companies, into enterprises, and revenue acceleration happening, and hence the tech, spend happening. So structurally across the segments, we are optimistic about the spend being a multi-year cycle.
Interesting. Now, SCI in particular, because payments is such a big thing, as you said, and you've announced a newly announced payment business unit as well. Sandeep, is this, how do I say, not necessarily a missing piece in the puzzle, so to say, but is this an incubation of something which may be small right now, but which may ramp up rather quickly? Because the street may not quite understand how quickly the ramp up could be. Can you give us some color?
Sure. So if you look at it, look at the India side of it, the kind of things, you go to a grocery store, you go to a side street vendor. Today, you can use Paytm or you can use Google Pay and so on. That was unheard of a few years back. I don't think any one of us imagined it could happen. And, if that is an example of the payment rail or the payments, ecosystem kind of maturing very fast. Globally, whether it is US federal side of it, whether it is the Canadian side of it, Australian side of it, payments are the place where a lot of investment is happening. There's a lot of action there, and there are multiple new payment rails that are evolving. Earlier ones getting modernized. So this is a very strategic investment from us. It may be a small
You might do more acquisitions as well, tuck-in ones, small ones, etc. in this space.
Absolutely. So it is the foundation. There will be more tuck-in acquisitions, but we want to first stabilize this. Look, acquisitions are as good as our ability to integrate and build upon them. So first thing is integrate, bring the teams together. Second step is bolt on, grow it into a much bigger tree.
Okay. Last question on clients and deal wins, Sandeep, and that is, I thought the deal wins were strong. They were largely in line with what you did in Q1, but you anyways had a very good exit rate. This adds on to it. Two questions rolled into one. One, with the quantum of deal wins that you have, even if the inflow rate slows down a bit, does this kind of give you the confidence that even if it were to slow down, FY23 is taken care of? And part two of my question, I ask this now, every company your size, slightly higher, etc., LTI and some of the others, is whether you can crystal ball gaze into how strong can this growth last. So Sanjay tells me that 3 years is a long time, and I can see 3 years the growth chalega. Beyond that is difficult to figure out. One more peer told me the same thing. I was trying to understand from you. Can you kind of crystal ball gaze? How long and how strong can this growth be?
So look, as far as the question on is FY23 done based on the order wins, depends on what do you want us to deliver in FY23. Right? So it is done if you want us to deliver average industry growth. It is not done if you want us to deliver on the top end of the cusp. So we are at it. We are building the company for the longer run. FY23 is another year. And we have said we want to hit $1 billion in the next 2 years or so. Hopefully we'll be there earlier than that. As far as your question about the demand environment is concerned, look, the demand environment is good. And as some of our peers have said, next 3 years look good. And yeah, I'll echo that. And hopefully it is beyond that. So optimistic about it.
Great. Good quarter, Sandeep. Congratulations on that yet again. And thanks so much, and festive greetings to you and the entire Persistent family.
Same there, and happy Diwali to you, your viewers, and look forward to seeing you next quarter.
Yep, likewise. Thanks so much for joining in today. Viewers, thanks for tuning in.
Bye.